Hi, this is Eric Boyce, CEO and Chief Investment Officer of BKA Wealth Consulting, and welcome to Charts of the Week for April 11th of 2022. Please see our disclaimer for important information. As we get started this week, I wanted to show you a few slides from some of the research that I was reading this week that I thought was pretty interesting. This one in particular, here we see revolving consumer credit. Now, basically the argument here is that as we have witnessed increased inflation, kind of pinches on purchasing power on the part of consumers and the absence of transfer payments that were very prevalent during the pandemic, we see here clearly that from January 2021 to January 2022 that we've had a pretty big pickup in consumer credit usage. In other words, credit card uses, revolving credit of that sort. Here's a quick look at the Baltic Dry Index, and this is a measure of freight cost, ocean-bound freight in particular, which really accounts for the bulk of a lot of consumer goods that are in intermediate stages of production in Southeast Asia, China, Vietnam, so on and so forth, and reaching their final destination for consumption here in the U.S. and other ports of call and other markets. But you can see prices were really a problem for freight, driving a lot of the inflation last year, culminating in a September peak in this particular price index here. And remarkably, we've had about a 77% retracement from that peak, but we're off of that low, even though we're kind of a little bit off on our interim peak. So I guess the real takeaway here is when we talk about these supply chain choke points, they're still prevalent, they're still worthy of consideration, still certainly worthy of monitoring, but they're just not as bad as they were. Although the freight index, when you look at 2020 and prior years, is still above where it was then. Another interesting chart here is labor force participation for ages 25 to 54. It's been very notable how, we've had a lot of retirements in the workforce in the wake of the pandemic, people just simply hanging it up and leaving the workforce. But, importantly for not only the labor market, but also wage inflation, is that we have more people entering back into the market. So participation is moving up in a very deliberate and incremental manner, which is good. I mean, right now we're sitting on about 1.7 or 1.8 jobs for every unemployed worker. So the more people that we have re-entering the labor force, the better we're off on obviously trying to fill jobs that are hard to fill, as well as having a greater supply of labor, which gives people more options for labor, which in turn brings down the rate of wage inflation that people are having to pay for scarcity of workers. So I feel like this chart is pretty profound, as it is very much as it is interesting. Here's a quick look at two different indicators telling us the same thing, really. The first one is a year-over-year manufacturers' new orders. And as we entered the year, we knew that that was going to slow, continue to slow, as we saw it slow up a little bit in the latter half of 2021. But if you look at the bottom, this is the month-over-month data. This is where you see the most noise in the data, and I think I just want to point out, to be clear here, as you look over this trend line, if you kind of break out the kind of the recessionary periods, back in the global financial crisis on the right-hand side of the amber-colored bars on the bottom half of this slide. And then you go over to the pandemic-induced shutdown in 2020. You can see in the middle, there's a lot of months where we were negative. So again, when you're in a long-term expansion, you do have monthly ebbs and flow in the data. And I just want to caution people against, overreacting to one data point. And if you look over the far right-hand side of that, yes, we were down in manufacturers' new orders. But if you look at the trend lines, look at that blue Now you can see that it does move back and forth. I mean, we're at actually a relatively good point still, even here, even as we are off our peak. And so look at the preponderance of data, and particularly here on the right-hand side of the monthly data, you can see that we've been up or flat for basically 2 years now as we've exited the pandemic. And so we were actually due for a little bit of a retrenchment. And what we saw in the last data point for manufacturers' new orders really wasn't that bad of a data point. It was off slightly, about 0.5%. So I thought that was very good for perspective's sake. So here's manufacturers' new orders less production. Now this is the one that I think is this is a different data point. So it's basically taking out what's being produced from what we're seeing in new orders. And so right now we've got that number is sliding down. So I think this is indicative of kind of the slowing that we're seeing in the overall economy right now. Obviously, when we get our first read at first quarter economic growth, we all expect that to be fairly anemic. And it's kind of bearing itself out in the data here as we see, new orders less production move a little bit lower. So, and we've got a couple slides on housing here, and so this one is not too surprisingly reflective of kind of the more challenging affordability environment now for housing. And so, you see the kind of the orangish dotted line up here representing respondents who say that it's a bad time to buy a home, move much higher, going back to basically almost April, almost a year ago. Whereas those people who feel like it's a good time continues to slide. And so net good time is kind of like net of all of that. You can see, where that lies. And, oddly enough, that number was fairly weak even last year before interest rates really moved up and mortgage rates moved higher. Certainly you've got prices that are higher, and so that puts a pinch. But for much of last year, we still had low interest rates, low mortgage rates. That is not the case right now, and so this number is apt to be weak for a while. And here's a 30-year mortgage rate. You can see on this chart as it's kind of as it flows through, and this chart goes back a long time, actually, almost to the beginning of this particular century. And you can see the back and forth and the up and down in mortgage rates. And, we've had relative strong affordability here for quite a while in the wake of, even, just before the pandemic, rates were already moving lower as interest rates were moving lower. Well, obviously that's reversed itself now. And so we're back at mortgage rates that we haven't seen since 2018. So we're, well over, essentially 4% now is kind of that threshold. In some cases, it's certainly higher than that, but you can see that we have picked up a full percentage point rise in the 30-year fixed conforming mortgage rate in the last 8 weeks. And that's the biggest rise that we've seen since 2003. And here's another interesting chart as we look at mergers and acquisitions. And we look over actually about a 14-year period going back to the essentially around the global financial crisis. And we can see the quarterly data here. And if you look at, really the last year, it was a terrific year for mergers and acquisitions. Maybe as we kind of pondered where we were in the cycle, you've got a lot of companies that we're looking to acquire growth actually and do vertical integration. At the same time, you also had pretty high margins and cash flow and stock repurchase activity. And what we've seen here in the first quarter, I think reflective of the overall environment with inflation, prospects for slowing, is that the appetite for M&A deal making has pulled back a little bit. But I think it's also important to realize that that the pullback is relative, right? Because we've seen such a banner year last year in deal making that I think it was only natural to assume that things were going to slow up a little bit and could continue to slow. But as you can see here clearly, that we're well above the trend line that has been established for over 14 years. Also interesting here, we see that in the SPAC market, which is special purpose acquisition companies, we've seen a lot of pulled IPOs, in other words, initial public offerings that have been withdrawn. So they're obviously not coming to market now. And so you've seen a huge spike. And so just as we saw with M&A, it's clear that the inflationary environment with prospects for slower economic growth have taken off a lot of the froth in this area right now. And so obviously there was a lot of enthusiasm on SPACs a year ago, particularly 2 years ago. And the bloom is kind of off that rose right now. And just we see lower overall capital markets activity right now. Here's a global look at new orders to inventories. We do see, the numbers here as you look over a longer trend line. So this is essentially a lot of basically 30 different surveys from across the globe aggregated into this one particular index. And you can see, that we peaked not too long ago, really, within the last 12 to 15 months. And so we've been off again. And you can see how this particular chart oscillates even within a global economic expansion cycle. And I think this number, tracking back down as it has, just tends to suggest that we're going to have a little bit slower growth. But really, this is something that we've been anticipating for quite some time. So this is almost as much a manifestation of what we've already anticipated than anything else. Now we'll talk about the oil market for just a little bit here. So we've got a chart of Brent crude, okay? So Brent is obviously different from West Texas Intermediate, but obviously there's a strong relationship historically between these two. And so it's definitely worthy of looking at here. And so you can see just from a price standpoint, if you back out the spike that we saw, and of course that had a lot to do with geopolitical issues as well as supply issues related to the Russian invasion of Ukraine. But you can see where prices have really kind of consolidated, even though the current prices are not too far off of this trend line that was established from essentially December of last year. But what's really important in a price consolidation is that usually from here you have some kind of a breakout. And I would tend to suggest that prices are going to remain a bit higher from a supply standpoint. I wouldn't have necessarily said that a year ago, but then again, a year ago we didn't realize that we'd have Russian crude off of the developed world market for the most part. Here's another slide on crude, and this is I think pretty telling here. So you look at the price change determinants. What are the reasons behind the price change? You can see here very clearly, even going back to December of this last year, that you had increased demand from an economy that was coming out of the pandemic. At the same time that you began to see some supply constraints, and that has obviously become much more prevalent here over the last 3 months, and you can see that in the red shaded bars underneath on the left hand side of this chart, underneath that overall line of total price drivers. And so we had demand at some point be very robust, and obviously with inflation, we've seen a little bit of downtick in demand, but overall gasoline demand honestly has not dropped off the cliff like you might think it would with high prices at the pump. But clearly supply issues have been a very strong influence on price changes. On the right hand side, maybe a little hard to read here, but the takeaway is that when you talk about oil supply and where do we find the slack production to help accommodate, demand in the world. OPEC is always a place that you look, and you can see here that production levels versus quota. Quota would be kind of akin to where you see that line of best fit across the zero line. So that would be at quota, but you can see that consistently month over month that OPEC has produced below its historical quota. And on the bottom hand side, you can see countries in particular that are well below their quota. You've got Nigeria, you've got Angola, you have Iraq, and you also have actually Saudi Arabia producing well below their quota. So takeaway here is that you've got Russian crude that's kind of curtailed, for probably the foreseeable future, and then you've got OPEC producing below its quota. Both of these things tend to suggest that we're going to maintain high crude prices for a while, and as a result, higher prices at the pump for gasoline. And to put a bow on this, here is a kind of a annual average. A blue line represents the average from 2009 to 2020. You can see in that red line where we are in 2022. So we are not only below our trend line, but we're actually out of the range. I mean, this is a full standard deviation away from the average or any observable data point really over the last decade or so. And so crude oil inventories are very low. We've talked about the supply issues out of OPEC and the supply issue impact on prices. When and this is just another representation of that, when you've got low supplies, low inventories here, and then it just reconfirms this notion that energy prices are going to remain high. And we shift over to natural gas, and you can see the same issue persists here. So natural gas prices very high, 638 per million cubic feet. You can see how that has oscillated over the years, and so we haven't seen this point really since 2009, exiting 2008. And then you can also see on the right-hand side, you've got the storage numbers, and the current data point is highlighted here, and you can see that while at least on the natural gas side, we're within a band, the maximum and minimum band, clearly we're at the lower end of that. So we're constrained on supplies for natural gas certainly as well. Here is the U.S. 10-year government bond yield, and so you can see here that obviously we've had a dramatic upturn. The news over the last week, amongst the many things that hit the wire, was this notion that the Fed is going to increase by a larger amount. Now, we had several Fed voting members on the public speaking circuit, and certainly Chairman Jerome Powell was out there as well, talking about the increased prospects of a 50 basis point increase at the next Fed meeting coming up in just a handful of weeks, as opposed to the 25 basis point or 0.25% change that they implemented last month. And so what that has done is it's created more of a pricing in mechanism in the market, and I think you can clearly see that here. Good news is that when you look at the 2 to 10-year spread, it actually has gone back to positive, meaning that the 10-year Treasury is above the 2-year Treasury. Right now the 10-year is 2.704% on Friday. Now the 7-year is 2.77, and the 5-year is 2.756. But when you get back to the 2-year, that's the difference there is basically 2.704 down to about 2.5% for the 2 years. So it's still relatively flat, but we've kind of at least on the 2 to 10 level and the 1 to 10 level, we have maintained, we are back to a normalized sloping curve. Here's a look at the 5-year forward-looking inflation rate 5 years from now. And so it's really looking almost 10 years down the road. And, I think as you could probably imagine, you've got, a lot of inflation that exists here in the pipeline today. And when that happens, people tend to, it's called familiarity bias, where, they're looking around them and seeing the inflation, and it's hard to see an environment where it normalizes in the future. And so when you get surveyed and you've got a lot of present inflation, you tend to kind of increase your future forecast. So right now, we're clearly seeing a higher level of that. We're almost 2.5%. And again, 2.5% forward-looking inflation rate is actually not too far off of what this 3% very long-term average has been. But I think 2.5% reflects the status that we've been in inflation probably over the last 25 to 30 years. Inflation, obviously, very recently, over the last handful of years, has been very low. But clearly, as we can see in this chart on the right-hand side, you can see that the sentiment as far as like future inflation has picked up just a little bit. I thought this was really interesting, and what it does is it breaks out kind of the sticky elements of the consumer price index. When you talk about sticky items, you're talking about rents and wages, and then that's in the blue line, and you can see that that blue line has certainly picked up. We're looking at like 4.5% there for these sticky items, but what I think has had a really large influence on the CPI being as high as it has been what we call these kind of flexible things, like auto rentals, and we've got other types of short-term inflation like hospitality prices and things like that, which tend to be a bit more flexible and fungible based on the circumstances that are at hand. And those items have obviously picked up massively, as you can see that in the orange or amber line here, 18.2%. So I just want to, I guess, emphasize here that there are certainly elements of the consumer price inflation basket now that are going to remain higher than they have been. And we see that in the blue line. But there are also a lot of elements in this inflation basket, as we've been talking about for months now, that will come down. And I think this amber line here is entirely unsustainable because you'll see demand drop off in these areas, and then you will see more equilibrium build as a result of that. And so certainly there are elements of CPI that will come down that will lower this overall number, whether or not the Fed raises interest rates and becomes really aggressive in that. But then there are obviously going to be areas that are going to remain higher. So overall inflation, as we look out over the next several years, is likely, again, to remain a little bit higher than what we've seen before. So this is a comparison of the S&P 500 dividend yield versus the 10-year. And so with the increase in the 10-year yield, again, the 10-year Treasury now is currently yielding about 2.7%, as you can see here in this chart. And with equities kind of having a bit of a bounce back off of the correction that we saw earlier this year, where we are in terms of yield is we're kind of at an interesting point. We haven't had this environment that we have now since about 2018. So, and that just means that the 10-year yield has increased dramatically relative to the yield on the S&P 500, i.e. the dividend yield, as you can see here. So from a competitive standpoint, just purely looking at the income element of investments, the 10-year Treasury has become much more interesting from a relative standpoint. Here is a long-term chart. I talk about this, secular bull market in interest rates and in bonds a lot. And this is a chart that kind of helps us understand how that's taken place. It goes back and looks at different, like really half decade increments here. And so, I mean, you look back at, the OPEC embargo days, we had about eight, anywhere between 7 to 9% inflation, or excuse me, interest rates. And then that really spiked in the early 80s where we had a lot of inflation. And the Fed came in and raised interest rates by a huge amount to choke off that inflation. Well, they were largely successful in that. And so, we've seen this prolonged period from essentially about 1983, where we've had this consistent and rather deliberate downtick in interest rates. And so this is that area that's shaded between those two bars represents this secular bull market in fixed income that we've talked about for a long time. And you can see, interspersed in all of in that long trend line there, you see elements where we had, really kind of major crises, whether it's Black Monday, that was 1987, S&L crisis, you had the Asian financial crisis, you had the dot-com bubble bursting, you had the global financial crisis in around 2007 into 2008, ending in 2009, and then you had the energy market collapse. So all these things have taken place, and you've seen this continued downtick. Now the naysayers say that that we have exited this cycle. We're now on this period of, maybe a bear market, if you will, in fixed income with rates moving higher. Well, that may very well be the case, and I do think rates are apt to move higher before they necessarily move materially lower from where they are. Obviously, the Fed rate increases are a big input into that thinking. Even if we have a recession in late 2023 into 2024, which is really the conventional wisdom now, you could have a downtick in rates, but I don't think this particular trend line continues because it's not really practical. Even though there are developed countries with 10-year sovereign yields that are below zero, in other words, negative, I just don't ever see the U.S. going there because of its status as a reserve currency. And from what I, gather in a lot of research, and I've talked about this quite a bit. The corporate world is in really good shape from a debt standpoint, from a leverage standpoint, from a margin standpoint, from a cash flow standpoint, and I thought this was interesting from Gina Martin Adams that if you look at the prospect of higher interest rates and their impact on corporate America, obviously you worry about that because debt service goes up and the ability to drive net margins goes down. But her point here is that we are at a net interest expense level that's already below where we were pre-pandemic. So we clearly have not become more profligate. In fact, we've become, balance sheets have only improved in corporate America. And then if you look at, in terms of profits, we're actually with debt relative to profits, we're in better shape than we were before the pandemic. And so the key takeaway here is that we do have levers in corporate America to kind of shock absorb, if you will, the prospect of higher interest rates looking out into the next couple of years. This is from JP Morgan showing year-over-year operating earnings growth. And I show this for a number of reasons, and I've had this in chart packs in the past, but you can see, if you go from one year to the next, there are different determinants of what happens to earnings. Obviously, you can see here that they tend to go up and be positive many more years than they go negative. And what we saw last year was a real anomaly. Earnings overall were up 70%. Most of that had to do with margin expansion, but also revenue growth as we exited the pandemic shutdown period. So I think as you go back to 2001 here, it's really hard to understand how we could continue that trend. Really, it's unsustainable. And so you look at 2022, I think it's very natural to assume that things are going to slow down, and that's okay. You can see that we've had many years here where, we've had relatively good growth. I think if you go back even to 2018, we had 22% earnings growth. 2017, we had 17% earnings growth, and a lot of that came from margin expansion, companies being more profitable. A lot of it came from revenue growth as companies in the index became better at finding new sources of revenue. And so those are frankly banner years. If you could have every year give you 15 to 20% earnings growth, I guarantee you the market's going to be a lot higher over the long term than it is now. But I think clearly there are years back in 08, 01, where you have a significant decline in earnings. Again, that's not that's not what the expectation is for this year. We're not looking at a big reversal of what happened last year. We're just looking for slower yet positive growth. So quick chart here, two different things. You can see that there's a reasonably positive relationship between these two, although this data set only goes back to really June of last year. So it's not giving us a whole lot of trend line data. But what's interesting in what we're looking at here, and the blue line represents the financial conditions index. So as inflation has taken hold, you see that number's come down, but at the same time, you see in the amber line, you've got the estimated number of rate increases, which is notated on the left-hand margin. So right now, the market at a time where financial conditions are already trending down, you've got this expectation for 9 interest rate increases. And I don't want to get carried away with the notion that is kind of an absolute. Obviously, that's where people think it's going to go. But again, two points. One, if the Fed is more aggressive on the front end and maybe institutes a higher rate increase next time, and maybe even a 50 basis point increase at the next meeting after that, then considering where interest rates have already gone already in kind of the short end of the curve, that may be the bulk of what they have to do. That coupled with the fact that they're going to start to allow its own balance sheet to run off. So so they're not going to be basically acquiring securities in the open market as they have been. They're going to start letting it run off, which will also remove credit from the system. A quick couple of charts. Next one will be about sector influence. But just as we stand here, obviously we had a correction. The markets have picked up lately, trading a bit sideways, kind of trying to find its footing. Obviously we got inflation. We have earnings coming up. We've got geopolitical tension. There's a lot of things that are influencing the pace of stocks right now. But just from a market health standpoint, we see here that, if you look at the S&P 500, I mean, frankly, we've got about 60% of the index is trading above its 50-day moving price average. And that's typically a pretty healthy signal. When you look at the Russell 2000, which represents small caps, and the number is a little bit less, around 50%. But with this little bounce back, you could look back in January, actually December through March, most of those were well below 50%, and that's picked up meaningfully. So just from on a very interim basis, the technicals look a lot stronger than they have. And here's a quick look at at that technical trend by sector in the S&P 500. And you can see, obviously, energy and commodity prices being super high, that energy's been exceptionally strong. All the members within the S&P 500 energy sector are trading above their both their 50 and their 200-day moving average, which is an even more telling indicator here. But you've seen also in utilities, REITs, healthcare, consumer staples, and even materials, the preponderance for at least on a kind of a near-term basis, looking at their 50-day moving average, are all trading well above that. And where you see kind of weakness against that technical trend is in technology, which it will be important. We'll talk about that in a second. And consumer discretionary, which is obviously a sector being impacted by inflation and consumption trends. And before we kind of talk about that, we'll talk about the cyclicals versus defensive ratios. And so cyclical stocks have really, have really kind of broken through. We felt like we were in a cyclical expansion, which I do think we are, but obviously we've got to tend to our inflation concerns at the same time. So cyclical stocks really outperform for a while, and we see here that relative to defensives, in essentially 2022, that trend has turned around just because we have more fear of inflation, less confidence in the durability of the economic cycle. And so as a result, we've seen cyclicals kind of take a back seat. And in this chart, we show you how defensives, from a relative standpoint, have really outperformed as of late. We were talking about operating margins before, and I thought this was helpful to show just to kind of back up that data. So you look at, we'll look at the aggregate, which is in that kind of that blue line. We could see over a number of years, we had margin expansion. Overall margins were moving up. In fact, last year we had a record operating margin, almost 13% in aggregate. You can see the recession bar there in 2020 with the pandemic-induced shutdown. And but I think what's interesting here is that the conventional wisdom still expects those margins to remain high, even despite inflation, even despite supply chain issues where prices, are hitting the production channel, unlike they have been in probably several decades. But what's interesting here is the presumption that those price increases can be passed along, and so I think what this maybe implies is that we get less overall sales, but since inflation is being passed through to the end buyer, that it gets negated in pricing from a profit and loss standpoint, and that even at lower levels of overall output and sales, that you can maintain margins. And what I talked about a few slides ago with the issue of technology being impacted, like a minority of technology stocks within the S&P 500 are trading above their 50 and their 200-day moving averages. And so, the top half of this chart shows you the weight of the top 10 stocks in the S&P 500. And that number, we thought was high, and actually it went down a little bit. Now it's picked back up. So 30.7% is the cumulative weight of the top 10 stocks in the S&P 500, which is roughly about 500 stocks. So, this is pretty profound. And the other takeaway from this is actually that the S&P 500 now is, especially with these top 10, these concentrated, very highly capitalized stocks, is that they happen to be dominated by technology firms. So this is interesting here that we have greater dominance by a part of the market that is by and large trading below its 50 and 200-day moving averages right now. And if you look at, maybe one reason why would be at the bottom half of this chart is the earnings contribution of the top 10 companies in the S&P 500 index. Again, a lot of these are technology firms. You can see that, as that has trended down, even though from a stock price standpoint and index contribution standpoint that those stocks remain high, it's clear that the earnings contribution from those has dropped. And this brings me to this particular chart, which I think is really interesting, particularly in that second set of bars here. So when you look at current valuation relative to long-term averages, and if you look at the current S&P 500 forward price to earnings ratio, at one point that was down to around 17 and a half. Obviously, we've had a pickup in the market a bit from the correction that we saw during the first quarter. So overall, forward price to earnings ratio in the S&P 500 is about 19 and a half. Well, 20-year average is about 15.3. So obviously we're trading above that. And if you look at the S&P mid cap and the small cap, you can actually see where there's a real value there because they're currently trading below their 20-year average. So think about that for a second. The question is there a catalyst that gets us there? And that's the more challenging aspect for small and mid cap stocks. But I want to point your attention, especially in light of that last chart about concentration of the top 10 weighted contributors to the S&P 500 index, and the fact that a lot of those are technology, and a lot of those technology firms and the top 10 contribution to earnings has dropped, that when you look at the S&P 500 on an equal weight basis, and that is just taking out the influence of these large mega company stocks, and then you just literally divide the influence by 500, you could actually see that we're trading very much in line with our 20-year average. And that's really interesting. So a lot of the work that I'm doing lately is looking at how do we, from a valuation standpoint, give more of an expression to an equal weight basket of S&P 500s, which by this chart tells us that we're not overvalued from that perspective. Here's a quick look at global earnings. Just looking at things from a relative basis. Now, we've been talking a lot about earnings over the last handful of slides, and we know that the U.S. has broken out. Obviously, post-pandemic, you can see that here that even before the pandemic, we were trending at a higher rate, and this is all indexed back to 2018. So pre-pandemic, we were doing better than the rest of the world in terms of earnings growth. We participated in the downturn during the pandemic, but we've accelerated at a faster rate than all of these other jurisdictions: Japan, Europe, Asia, Far East, or Africa, excuse me, Far East, Eurozone, and the emerging market areas have all kind of moved in tandem, and they've all moved higher. And overall earnings are above where they were before the pandemic, but the U.S. has clearly outpaced them in terms of growth. Here we have what happens to the S&P 500 during Fed tightening cycles. And I hadn't seen a chart quite like this, but I've seen this data. And so overall, the S&P 500 actually predominantly moves higher during Fed tightening cycles, at least for a period of time. And here you've got essentially 250 days after the first tightening, which is that point is at the point of origin here, where on the left hand side of this is all the performance leading up to the first tightening cycle, and then everything to the right represents after the first tightening cycle, or at least after the first rate hike as a part of the tightening cycle. And then the only case where you don't have good stock performance is when you have what they call a fast cycle. And so there is some speculation that what we're about to see is a fast cycle where this expectation we're going to have 9 interest rate increases this year. And the Fed's going to be very aggressive about that. And the Fed's talked about wanting to make sure that they get a hold of inflation. And so I think that is a scenario that we'll have to pay attention to because a fast tightening cycle is typically associated with more sluggish equity performance. So, this chart is to say that from an average point of view, that you're going to get better stock performance, or you're going to have stock prices go up, I should say, during a tightening cycle. So don't be scared of that, except in the event where you have this ultra fast cycle. And so that's that's obviously something that we're going to have to pay attention to, and obviously react to if we, as we see the market react in the coming months over the next couple of Fed rate hike moves. In our last chart of the week, I saw this and it made me think of, this competition, this new Cold War, if you will. Russia's influence on the global economy is not nearly what China's is. And so all this hubbub over Russian sanctions and the impact of Russian, trade, China, it means a lot more to the rest of the world. And we talked about, onshoring of industries. We talked about, reduced globalization because of this competitive backdrop that we have here, particularly with China and theft, non-protection of intellectual property, and a whole host of things that, that we ding China on right now. But what's interesting here is that just in the area of semiconductors, is we worry a little bit about, what kind of a read China's going to take from the Russia invasion of Ukraine on how it deals with Taiwan, because a lot of semiconductors are produced in Taiwan. However, in this chart, I just highlight here that, that may be the case, but China depends very heavily on the US and the Western world for semiconductor equipment. And obviously, you can't make semiconductors if you don't have the equipment to do it. So, in a small twist of irony here, I do highlight the fact that while China is increasing its contribution to the semiconductor world, and clearly not to take anything away from the fact that China currently is the world's largest producer of rare earths, which go into a lot of electronic components. So I'm not saying there isn't risk. I'm just saying that the irony here is that with China's kind of presumed dominance in semiconductors, they still depend on the West for the equipment to make it. Well, that will do it for the chart pack this week. Hope you've enjoyed it, and hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.